Right, hi everyone. Now, I'm sure a lot of you new to investing keep hearing the term dollar cost averaging or pound cost averaging or, cost averaging down. Now, if you don't know what that is, it's very, very simple. So what I'm going to do is show you this example of realty income here. Now, this is the monthly chart. So if we look back, this was like $82. And as you can see, the price has gone a lot lower. So if you'd bought here, if you carried on buying all the way down here, you would have reduced your losses and averaged the price down. Right, let's take a look at an example. Now imagine for a minute in your wildest dreams, Apple's share price was just $10 a share, right? And you love this company, so you bought 10 shares. Now, that investment is now worth $100. Well, fast forward a couple of weeks and there's been bad news. Nobody likes iPhones anymore. Everybody has gone back to Nokia. So now the Apple shares have dropped to $5 a share. So now your investment is only worth $50. You've just lost 50% of the value of your shares. So you really like Apple as a company and you think this is just a bumpy road and people, they're going to fall out of love with Nokia and come back to Apple. So you buy another 10 shares at $5. You now own 20 shares in Apple worth $150. Right, so your $150 investment now we'll divide it by 20. So that's the amount of shares you own. This is now worth $7.50 a share. So you started off at 10, the price dropped obviously to 5. And now because we've just bought more when the price is reduced, we've just increased that average cost to $7.50. So we have just averaged down. So that is what you hear called, you'll hear it in numerous videos, people calling it dollar cost averaging, people saying just I'm averaging down in this stock, or if you're in the UK you might hear pound cost averaging. But that is as simple as it gets, really, and it's just a basic technique for minimizing your risk, and it's a safer way of investing into a company over the long term. This obviously works whether the market's going up or down. If you're just investing a tiny bit every week, you're always going to get an average cost over the long term, rather than just, if Apple, for example, had dropped to the $5 and you had like £10,000 to invest or something, and you invested it all then, the price could go lower, so you really want to be trying to average the cost down, but it's just like anything, no technique's perfect, but this is just one that's tried and tested and has stood the test of time, because obviously markets are very volatile, and as we can see right now, things are a bit crazy and the price fluctuates and goes up and down. So yeah, I hope that's helped a few of you out there who didn't know what that was, because I know a lot of the language can sound very complicated and baffling and stuff, but really it's not. It's just like anything, once you start learning, you'll start picking these things up and you'll feel more comfortable and you'll feel more confident in using this language yourself and placing your investments in the future. But yeah, thanks for watching guys, and I'll speak to you all soon.